Thank you for joining today's Quantitative Disclosures Summary presentation. I am Kawai in JSCC's Clearing Planning Department. I will be leading today's call. Today's session will last approximately 30 minutes. We will begin with an overview of this quarter's disclosures, followed by a discussion of this quarter's key topic, the CCP Global International Default Simulation conducted from November 4th to 12th, 2025. And then a briefing on the major risk points. We will conclude with a Q&A session and address as many of your questions as time allows. All participants will be on mute during the presentation. If you have any questions, please submit them using the Webex Q&A function. With that, I will now begin the overview of the quantitative disclosures for the first quarter of 2025. JSCC keeps 76 billion yen of skin in the game, mostly from JSCC's own capital, but it also includes contributions from affiliated exchanges. On aggregate, these were equal to 71% of JSCC's shareholder equity. During this quarter, stress test breaches where the risk amount in extreme but plausible market conditions exceeded pre-funded resources were observed on 2 days for cash securities clearing service. All of the breaches were resolved on the next business day through the requirement for additional collateral. As for margin backtesting for the past 12 months, the cover ratios were below JSCC's target in IRS. As a result, we revised the stress scenarios for IRS in May 2025. JSCC's risk appetite is set at 99.5% for IRS and CDS, and 99% for other products. There were neither liquidity stress testing breaches nor any participant defaults during this quarter. JSCC experienced no suspension of the clearing service due to system failures or nor any other reasons during the past 12 months period. Let me move on to the topic of this quarter, which is the CCP Global International Default Simulation, often called the Global Fire Drill. From November 4th to November 12th, 2025, JSCC took part in a coordinated global default simulation together with other major CCPs around the world. In this exercise, we assumed the default of a large internationally active financial institution. The simulation was conducted at the same time across participating CCPs, and here in Japan, it involves close coordination with the Financial Service Agency, the Bank of Japan, and a total of 53 financial institutions, including banks and the securities firms. Compared with the first global simulation held in 2023, this second exercise was broader in scope and more detailed. The main objective was to further strengthen default management capabilities and to reduce the risk of contagion from the default of a major risk clearing participant. For JSCC, this exercise also provided an important opportunity to test our existing default management framework under a severe but plausible scenario and to assess how effectively we can coordinate with overseas CCPs in a real crisis situation. On this slide, I'd like to focus a bit more on the practical and operational aspects of the simulation. For participants who chose the new default management method, we conducted dedicated sessions to walk through procedures related to a client default. The aim was to make sure that everyone clearly understood the steps to be taken and the roles of each party. We also carried out a new training on client position transfers. This was done in close cooperation with Osaka Exchange, TOCOM, and the relevant clearing participants, and it focused on how client positions would be transferred smoothly in a default scenario. Overall, The simulation was completed successfully with no material issues identified. The exercise provided valuable insights into operational readiness and cross-market coordination and further strengthened JSC's ability to manage a large-scale default, while continuing to enhance its default management framework. Now, back to the PQD. This page is an introduction of JSCC's service structure. Clearing services are divided into 14 categories according to the governing regulations and product features, with each maintaining its own default funds. Please note that in this presentation, some data is presented across multiple categories as the resources may be shared. Page 10 shows daily average notional value of trades cleared by asset class. Please note that the figures are calculated single-sided as we indicate in the explanatory notes of the PQD. In particular, the notional value for IRS increased by approximately 1.5 times quarter on quarter. Page 11 shows financial resources for participant default, called Skin in the Game or SIG, and contributions from relevant exchanges and PTSs. Most of the exchange contribution is from entities in the same corporate group as JSCC, namely TSE, OSE, and TOCOM. And for stress testing, the sufficiency of the financial resources for each category was tested by prorating these shared resources according to the relevant default fund amount for each category. Page 12 shows the ratio of skin in the game to JSCC's capital. The left-hand graph shows the skin in the game to be used before the mutualized default fund or DF. And the right-hand graph shows the skin in the game to be used before the default fund plus alongside default fund and non-defaulting participants on a pro rata basis. As described below, compensation by exchanges and PTS are included in SIG for ETP. Skin in the game before default fund on the left ranges from 17 to 79% of shareholder equity. So JSCC contributes relatively large amounts of shareholder equity to skin in the game compared to other major CCPs, which reflects JSCC's strong commitment to prudent and robust risk management. The ratios of skin in the game to default fund on the left range from 1 to 41% of default fund, while those on the right from 2 to 62%. Page 13 shows the required default fund, which covers any default-related losses that would be mutualized among non-defaulting participants. The graph on this page shows the ratio of skin in the game and contributions from exchanges to default fund from members. Following a sharp increase in the previous quarter, driven by rising gold prices and large positions held by top-risk participants, the default fund for precious metals has stayed at a high level this quarter. On page 14, the data is listed for these graphs, and the amount of potential assessment or so-called cash call is also provided. As stated in the footnote, the cash call for NETD is capped at 3 times the default fund requirement. And for OTC products, it is capped at 1 time the default fund requirement. Page 16 shows the largest value and mean value of the slowing, which is the stress risk amount exceeding initial margin deposited including add-ons. Please note that due to the PFMI quantitative disclosure definitions, the default fund shown on page 13 is the value at the end of the quarter, but the slowing on this page is the largest or mean value during the past 12 months period. JSCC's default assumption is covered too, except for any listed commodity derivatives other than OSE Petroleum, which is largest one plus the 5 smallest firms in net assets. Among all clearing service categories, ETP index futures options had the largest volume, with a peak value of 554 billion yen. Page 17 shows the number of days there was a shortfall in the stress testing of pre-funded resources, and the largest shortfall. Breaches were observed 2 days for cash securities. All were resolved on the next business day through the requirement for additional collateral. Page 18 shows the required and excess initial margin amounts. The dark blue is the house initial margin requirement, and dark orange shows clients. Light blue is the excess margin for house accounts, and light orange shows client accounts. The required amount of OSE listed ETP, IRS, and OTC-JGB were the largest at between 2.15 and 2.68 trillion yen. Looking at the breakdown between house and clients, OSE listed ETP was driven mostly by clients. IRS was evenly split between house and clients, and OTC-JGB was mostly house. This trend has remained unchanged for quite a long time. Moreover, the client's excess margin held was quite large in OSE listed ETP and IRS, which has also not changed significantly. The data used for the graph on this page is shown on the following 2 pages. Now, page 21 shows the number of breaches in IM backtesting for the past 12 months period. On this page, you'll find data on breaches in our initial margin backtesting over the past year. As noted in Q2 2025, breaches increased significantly in April due to U.S. tariff-related market fluctuations, which caused coverage ratio to fall below target levels across multiple services. In the current quarter, the same period remains within the 12-month range, and we continue to observe elevated breach numbers. For IRS in particular, our coverage ratios remained below target levels. The upper chart on page 22 shows the largest breaches in the past 12 months. This test only looked at the base IM requirement without add-ons. JSCC has assessed that these breaches would have been covered, if necessary, by resources such as IM add-ons, excess IM deposit, or skin in the game, and that the default fund would have remained almost untouched. The lower chart of this page shows the largest breaches in the past 3 months. The upper chart on page 23 shows the quarterly largest value of variation margin, or VM, paid to JSCC, and the lower chart shows the largest value of IM called during each quarter. For OSE listed ETP and OTC-JGB, the increase was due to U.S. tariff-related market fluctuations in April. Please note that while the VM needs to be deposited and settled in cash, IM may be deposited in cash as well as various securities and other instruments, giving our participants some flexibility for funding. Page 24 and 25 shows the composition of collateral used for IM deposit. On page 24, you can see that the majority of IM for ETP cash securities and for CFA regulated ETP was cash, as shown in dark orange, but some was in JGB and stocks shown in gray and yellow. Cash collateral was held at either the central bank or at selected commercial banks. The secured cash deposited at commercial banks in dark orange was held in settlement accounts by commercial banks, which are fully covered by Japanese Deposit Insurance Scheme or through reverse repo transactions. For the OSE-listed ETP in middle graph, there is a trend observed where the proportion of cash deposit has decreased, and the proportion of non-cash equities and JGB deposit has increased in an interest-bearing environment. On the next page, you can see a shift from cash to JGBs and a preference for commercial bank deposits over central bank deposits after the change in the Bank of Japan's monetary policy. Deposit of stocks are not allowed for these OTC categories. Please note that the entire amount of cash collateral for OTC JGB was held in the central bank, and for CDS and IRS, the participants or customers may select their custodian for cash collateral, i.e., a Japanese trust account or the central bank account in the name of JSCC. The secured cash deposit at commercial banks in dark orange for CDS and IRS was held in such trust account, which is legally protected from a bankruptcy of JSCC as well as the participant. Page 26 separates cash deposits into those for initial margin and default fund. We are holding total of about 6.6 trillion yen of cash collateral across all the categories. Next, this page shows the custodians for this cash collateral, with almost 100% held in either the central bank account, settlement accounts covered by deposit insurance, or the trust account. Page 28 covers liquidity risk management. Please note JSCC's liquidity risk appetite is covered too, but this data is presented based on cover 1 in accordance with the PQD guidance. And while JSCC separately calculates and manages default fund by category for liquidity risk, JSCC calculates and manages it across categories. However, for OTC JGB, JSCC has established a separate liquidity framework using repo with clearing participants, because the transactions under this category involve large amounts of principal settlement. In the chart, you can see that the liquid financial resources significantly exceed the required amount, and no breaches were reported in the liquidity stress testing. At the time of a participant default, at least the half portion of non-cash collateral could be liquidated and applied to the settlement with survivors. However, in this data, non-cash collateral is not deducted either from JSCC's payment obligation of the estimated payment or the actual payment. Because to be conservative, we consider that it could be difficult to swiftly liquidate such collateral on the date of default. Accordingly, such collateral is not regarded as immediately available liquidity resources for the purpose of this disclosure. Page 29 shows the liquidity resources for the categories other than OTC JGB. Cash is deposited at the central bank shown on the first line, and secured cash deposited at commercial banks on the third line, depending on JSCC's rules. For ETP, when the clearing fund requirement exceeds 1 billion yen, half of the excess must be deposited in yen cash by each clearing participant. Therefore, the level of cash varies depending on the default fund requirement. The unsecured cash on the fourth line shows JSCC's own funds available for use as liquid financial resources following a participant default. The unsecured committed line of credit on the sixth line shows the committed liquidity available from JSCC's parent company, and multiple commercial banks that have been designated as fund settlement banks, and total to more than 1.5 trillion yen. Now we will move on to Q&A session. If you have any questions, please let us know using Q&A function. We have received a question in advance. The question was, how have recent geopolitical developments in the Middle East affected energy markets, and how has JSCC responded from a risk management perspective? Thank you for your question. Well, in short, margins adjusted primarily through our existing models. Electricity and LNG margins increased automatically under daily HSVAR, while for Platts to buy crude products, we applied an ad hoc update after prices moved beyond our thresholds. In all cases, margins continue to target coverage above 99%. I hope this answers to your question. Thank you. We received a question. The question is, how was this simulation different from the one conducted in 2023? Thank you for your question. Well, compared with the first simulation in 2023, this exercise was expanded both in scale and in complexity. More CCPs participated. The assumed default scenario was larger, and the level of coordination across CCPs and market participants was more advanced. This allowed us to test cross-border communication and operational readiness in a more realistic environment. I hope this answers to your question. Thank you. With that, I would like to wrap up today's webinar. Before we wrap up, just a quick reminder. The recording of this webinar and any related materials will be shared with you in our website. If you have any further questions or feedback, feel free to reach out to us directly. Once again, thank you for joining us today. We hope you found the session informative and valuable. Thank you.